Hey guys, I'm a student at FDU and I'm here to talk to you about cost, volume, profit relationships. We're going to go over contribution margin, the contribution margin ratio. We're going to do examples of each and then we're going to do a final example putting those two together. Alright, let's go to it. Alright, first thing you need to know is the cost, volume, profit relationship is the examination of the relationship among selling prices, sales, and production volume, costs, expenses, and profits. The ways that cost, volume, profit relationship can be used is analyzing the effects in selling, analyzing the effects in cost, analyzing the effects in volume, setting the selling prices, selecting the mix of products to sell, and choosing among marketing strategies. Alright, right now I'm going to go over the contribution margin. Okay, now we're going to go over the contribution margin, which is the excess of sales over variable cost. Contribution margin equation is sales minus variable cost, and here's going to be an example in maybe the workplace. You're going to have sales of $50,000, sales price of 20 per unit. The variable cost is going to be 12 per unit as well. Alright, what you're going to have to do is, for sales, you're going to have to do sales price times the sales, which is going to be 50,000 times 20, you're going to get 1 million. And then for the variable cost, you're going to do the variable cost, which is $12 per unit, and you're going to multiply it by the sales, which is 50,000, and then you can get 600,000. And the equation is sales minus variable cost. So you're going to do 1 million minus 600,000, and then the contribution margin is going to equal 400,000. And that's how you're going to find the contribution margin. Next, we're going to do is the contribution margin ratio. Okay, now we're going to go over the contribution margin ratio, which is the percent of sales dollar available to cover the fixed costs and also to find out the income from operations. The equation for contribution margin ratio is the contribution margin divided by the sales. Now, in the example before, we found out that the contribution margin was 400,000. So what you're going to have to do is divide that by the sales, which from the example before was 1 million. So you're going to do 400,000 divided by 1 million, and you get 40%. And that's going to be how you find the contribution margin ratio. Next is we're going to do one big example of putting the contribution margin and the contribution margin ratio together. Okay, for the final example, we're going to put both the contribution margin and the contribution margin ratio into one big example. Alright, so you're going to have, say you have sales of 80,000, you have variable of 9,600, you have variable selling of 22,000, and then you're going to have variable promotion for 14,000. Alright, so what you want to do is you already have the sales, so what you have to do is you're going to have to add up all the variable amounts. You have to find the variable to find the contribution margin. So when you add all these up, you get 45600. You're going to get 4,500, 600, and then you're going to have to take 80,000 and you're going to have to subtract it from 4,500, 600, and what you're going to get is 34400. Oops, I made a mistake. It's 34400. Okay, so now you have the contribution margin. So what you're going to do is you're going to take 34400 and you're going to divide it by the sales, because that's the equation of 80,000. And then you're going to get the contribution margin ratio, which is going to be 43%. And that's going to be an example of putting the two contribution margin and the contribution margin ratio together. I hope you guys enjoyed this. Thank you.